Good afternoon. I'm so sorry to have to show you myself twice. I hope I can be as entertaining. In fact, this is more squarely where I spend a lot of my time at CFSI, so I should be able to answer questions you have with more depth here. Really excited, again, to be able to speak to you guys again. So I do want to take one moment to talk a little bit about who CFSI is, which I didn't really do when I first presented. We are a nonprofit in the US focused on consumer financial health, particularly for those who are underserved. We're a little bit unique, although there are a lot of parallels, frankly, to the way Prosper works. But we have 4 arms to our business. We connect companies that are leaders in financial health. We sort of bring them together for events, networking opportunities, and conferences. We do a lot of research to inform the marketplace. That's the division that I run, where we do research on consumers. We do research sort of generally on financial health, specifically on consumers of insurance products or prepaid cards. And then we also look at the innovations in the marketplace, some of which David was talking about, that we think are the most promising. And then we try to seed innovation, predominantly through fintech companies. I'll talk about our work there a little bit later on, that we think can then sort of bubble up into the marketplace. And then we also run essentially a boutique consulting firm working with mostly larger institutions, helping them to design better products that can improve financial health. So that's sort of who we are. This is our network of companies. We do have a few Canadian members, mostly on the credit union side, although we're hoping to change that. A number, basically most of the big banks from the US are part of this, all on our website too, are all in the network, as well as credit bureaus, credit card companies, the back-end fintech, the large fintech and the small fintech, and then a handful of the most innovative nonprofits in the space. So it's really an incredible group of people that we get to bring together and learn from all the time. So I'm going to split my presentation in half. First, I'm going to start off by talking about what we think medium and larger financial institutions can be doing. And then a second, I'll talk about our Financial Solutions Lab and the role we see for fintech. At the big picture, the vision that we're sort of putting forth into the marketplace is that the industry needs to change the way it thinks about itself, to shift from being in the financial services business to being in the financial health business. So the idea is that the bottom line of our company is as important as the bottom line of our customers, and that their financial health and improving financial health outcomes for our customers is a way we measure our own success, alongside being a viable and sustainable business. And in the most case, we're focused here on private sector companies. In order to do that, sort of what does it mean then to advance to become a financial health company? We created our little path that we call the financial health journey. And this comes from our 14 years of working with companies, and this is how we've seen companies kind of take those steps along the path to be more committed to the financial health of their customers. Liz, I don't know if you did this intentionally, but in some ways this mimics today. And the way that this conference was planned out. So we sort of started with orienting to the big picture, in this case the US. Then we kind of aligned ourselves more to the context of our own circumstances here in Canada. And got some data that was diagnosing the financial health of Canadians. And then now we're in the design and deliver, right? What are the solutions? And of course, where we want to go, maybe the next conference is where we're actually tracking the improvements and how things are changing over time. So you can look at that at the country level. We use this really at the institution level. So if you think about a bank, so let's imagine your stereotypical medium-sized bank here. They come to us at very much different stages in the journey. Sometimes when we talk to a bank, they don't even know what financial health means. They're really been focused on sort of mass affluent customers their whole life, but they're waking up and wow, this is a really big issue. And most banks, at least in the US, kind of post-recession, started having this awareness, and then they started looking at the data, right? Then they got to say, well, what does it mean for my customers? And that's where we help them diagnose the financial health of their own customers. And I'll say this has been a surprisingly critical part of working with financial institutions, is that even if you imagine a large financial institution, and I know you've got, 5 here, right? 6, okay, you got 6 big ones, right? And so their customers are gonna more or less mirror the national average, right? When you have a big enough sample set. But it is amazing to show a bank their own customers. I'm sure TD was fascinated by seeing its own customers, even if that data was not so significantly different from the national data. So this is just something for you guys to think of mind. It's the value of local data too. Neighborhoods and states and provinces value seeing their own data. It just means something very different to them. And then you can kind of advance along that journey. Once you know where the problems are of your own customers, you can start thinking about what are those solutions. And that's the kind of work that we do. Of course, we also have to make the business case for financial health because, especially in the US, although I think everywhere, if they don't see the business bottom line, they're not going to move forward. We're currently in the process of actually putting some more numbers behind this. We have a paper coming out next week that's going to lay out this framework that we think for the business case. On the left is a great study. This is from Gallup a few years ago. And the orange bars are customers who said they strongly agreed that their bank looks out for their best interest. And then the green bar is all others. And so when you have a customer who feels that way about their bank, and we would use this as a proxy for feeling that their bank sort of cares about their financial health, what you find is twice as likely to be satisfied with all the channels that they're using, and then 4 or 5 times as likely to saying, this is the only company I need, right? So you're really increasing your share of wallet, you're increasing your customer loyalty and customer retention, and those are numbers that banks really value when they're thinking about making the kind of investments that this work often requires. And you do have to have a little bit more than just the short-term view. You can think about it from the profit per customer. Am I increasing my balances? Am I helping my customers, say, have fewer delinquencies or fewer charge-offs? If I help make sure their credit scores are better, for example. But you also, then those customers become longer-term customers, and you also have these intangible benefits, that your brand value goes up, the regulators may see you in a better light, and employees get more excited when they feel like their bank is committed to doing something right for their customers. So this is sort of the business case that we talk about. We also put some numbers behind it. In the United States, this is research we've been doing for several years. Underserved consumers spend $173 billion per year on fees and interest for financial products. And these, in most cases, are not the most innovative and not the most high-quality products. So you've got really short-term credit, installment loans, payday loans, pawn loans. You've got some subprime auto loans in here. So there's a big opportunity for providers to come in, take this money with a better product, serve customers, and make a profit at the same time. So that's the business side, right? And the banks are very good at knowing how to measure if they're actually making a buck on this. Where we spend a lot of time focusing to get the financial institutions to do more is to show them how to measure. And so we developed these 8 indicators of financial health. Actually, the TD Bank survey used some of them in their survey that's similar to other measures that are out there. These are ours. And we use the spend, save, borrow plan as a really simple rubric for thinking about what is financial health and how do you measure it. We have a survey form of this that's 8 questions. Any bank, credit union, nonprofit can just give this to their customers and very quickly come back with a snapshot of the financial health of their own members. And just to show you that there are companies actually doing this, in 2017 we ran a program called Financial Health Leaders, where we started off with that 130 companies from our network, and we said, okay, if you're serious about financial health, then you're going to measure it, and you're going to measure the health of your own customers. And we got, I think, 22 companies to sign up, including Service. I think it's our only Canadian company here, credit union. But we got credit unions, fintechs, we got a couple big banks, Key Bank. The credit unions actually really get excited about this, which is interesting. But a variety of companies that are sort of doing this, and then all of them are going off in different places, right? Once they see the financial health of their customers, and in many cases they realize, wow, 1/3 of my customers are really struggling, or maybe it's 2/3, depending on where they sit. They start thinking about, what should I be offering? We've seen credit unions put financial coaches in the branches. We've seen companies that are lenders realize that they need to offer a savings product alongside the lending product. So this is part of our kind of wake-up call. These companies are leading the way. We're hoping to double this number for this year. So then, you've done the diagnosis, right? You've oriented yourself, so what? Right? What is the solutions? And we just heard some ones that were very specific to income volatility. In the big picture, these are the way we sort of group the types of solutions that we think institutions can be offering to improve financial health. And you can break it down by looking at products, programs like financial advice and guidance, people and the way you're training your staff, and then places. What do your branch and digital infrastructures look like, and how do they support the good outcomes for your customers? Ultimately, each institution picks their own path based on where they are, what their assets are, what their diagnosis reveals, and then moves forward. Now I'll take a minute just to talk about some of the trends that we're seeing in the bank space before I switch over to fintech. It's not as much as we would like, but this is sort of the high level. We heard about some of the innovations, the most promising things, but this is what we're actually seeing in the US. So one thing is we are seeing more of the large and medium-sized banks especially move away from free checking, which you may know was actually just sort of built on the back of overdrafts for a small number of people that was sort of making that business model work. And now we're seeing more companies come out with a low cost, often no frills kind of checking account that allows people to move money in and out and pay for the things they need, often has no overdraft. Sometimes it's digital only, but we really like these products, and it's $5-7 a month, but then it's reliable, right? It's not as volatile because you're not going to have that overdraft 2, 3, 12 times a year, depending on the customer. We're also seeing some of the behavioral stuff that we heard about being bought into these products and prize-linked savings again. So I mentioned that here. We're seeing some of that take place. On the lending side, we're seeing more on the smaller side, smaller banks and credit unions doing some interesting things around affordable credit products or credit products that are offered to people with non-prime or subprime credit scores. We're seeing some really interesting partnerships between banks and online lending. Citi has a partnership with Lending Club that's really interesting. And then on the channel side, we're seeing this convergence between physical branches and the digital infrastructure. So you can walk into your branch, but then you may see a video screen where you talk to a customer service center, or there may be a kiosk that'll make some kind of alert, or you're using your phone for one piece of it, and then you're going to the branch for other things. And especially for people with busy lives, especially people that have multiple jobs, as I was talking about earlier, having this kind of flexibility and availability is a huge experience. And then we're seeing particularly some cool apps coming out from the banks to help people around financial management, financial advice. One of the biggest partnerships that we saw recently is KeyBank purchased Hello Wallet, which is one of the biggest PFM, personal financial management apps out there, and they're really integrating that into their entire customer experience. So we are seeing some good things. I didn't want everything to be so pessimistic today with all the research that we're looking at. So that's the big guys. I'm going to switch now. How am I doing on time? I'm okay? All right. And talk about fintech. And my primary lens for talking about this is the Financial Solutions Lab. And I'll give you a little background on it in case you guys decide it's something that somebody wants to do here in Canada, because it's been phenomenally successful. So this is a program partnership between CFSI and JP Morgan Chase called the Financial Solutions Lab, funded by a $30 million 5-year grant. We are the sort of primary operator of the program, and the goal is to identify, test, scale these promising innovations to improve financial health, primarily through fintech startups in the US. We do work with a handful of nonprofits. We do a challenge every year, and so we actually just launched our 4th challenge. We're in our 4th year. We've had 3 cohorts now. We get almost 300 applications a year. We pick about 10 winners. You have to be sort of relatively early stage, but in market with customers. So we need to see some take up. And then we work with them over a 9-month program. Essentially, it's an accelerator. We bring them together 3 or 4 times. We show them our research. We connect them to all of our partners. They get introductions. They come down to the Hill and meet with legislators and policymakers. And it's a really powerful experience for them and allows us to work closer with them and make sure that they're really keeping that focus on underserved consumers. This is just a summary of those benefits. It does include a small equity investment, access, expertise, and then exposure to all of our partners. So these are the winners of the most recent challenge. And so if you want to see kind of what's happening in that fintech space that we're excited about, these are some good examples. We were talking about retirement a second ago. Blueprint Income just closed a major round of funding, and they're basically like modernizing the annuity, where you can set yourself up for a kind of guaranteed income stream down the line. Dave allows you to you connect Dave to your checking account, and it makes sure you're not about to overdraft for those features. Those bank accounts that do have overdraft, it gives you a warning, and then it gives you a little bit of cash flow with 0% interest to make sure you don't overdraft. And then Nova, which I think is interesting, the immigrant population has come up a few times today. Nova is sort of the first cross-border credit reporting agency. And they operate in Canada and in the US. And one big problem for immigrants coming is they may have a credit history in their home country, but that doesn't translate to a credit history in the credit bureaus here or in the US. And so Nova has sort of translating between different bureaus. I think they have Mexico, India, UK, and one other lined up right now. And then, so for a small fee, basically a lender can go and access the credit history of someone that's signed up through their system, and then be able to make them a loan based on really robust data that is also compliant with the, the federal needs that they have to go for. So that's just a highlight. This is all on our website if you want to check out these companies. And if you know any cool companies, encourage them to apply for the current challenge. And then sort of to wrap up the impact that we've seen to date, we have over 26 companies that we've supported. A few have folded, as it goes in this world. These companies do now reach over 2.5 million Americans. So we are talking about scale. That's some scale. And they have seen 15x growth since joining the lab. And these companies have collectively raised over $250 million in follow-on capital since they were part of our program. Yeah. So that's what I have. I'm happy to take any questions and kind of go into more depth on any of those things.
Great. Well, we've got 15 minutes. Plenty of time for questions. So anybody has a question?
Just a quick question with regards to the performance metrics that you put up at the end there. So I just wanted to clarify, the follow-on capital they've been able to attract is other, like either patient capital or angel investor capital or those kinds of things. Is that right?
This is mostly, no, it's mostly VC capital.
Okay.
Yeah, no, they're past the angel stage in most phases. Okay. Yeah, the 250K is misleading. We're often a small investor in usually a Series A round. So it's usually a Series A prime or a Series B round that then they're going on to.
I just wondered if you had any data with regards to the profitability of any of those new platforms, like just in terms of any revenue that they're able to generate.
Is Uber profitable yet?
Good question.
But so I don't. We have a lot of data on revenue. I don't know that any of them yet are profitable. We've had 2 exits so far. One company got bought by a bigger fintech company. And then there's another that I don't know the details on. I think it's still a little too early. I mean, our oldest cohort is only in their sort of 3rd year. Yeah. But we're hoping. I will say this: we do your question sort of suggests this is not meant to be patient capital per se. It's not meant to be capital or subsidized. Like, these are real investments, and they have to be fully viable business that should be, that's why the follow-on capital really means something. And those are serious. These are not social investors that they're getting follow-on capital on. We do the full due diligence of any investor, plus we make sure that they're improving financial health for underserved consumers. Yeah.
Rob, can I ask you one more question?
Absolutely.
In the last presentation, David touched upon this kind of conundrum of institutions who are best positioned to act versus most likely to act. And you were talking about essentially private enterprises taking more of a, I guess, consumer stakeholder-led approach versus maybe shareholder-led approach. And maybe I'd just love to hear a little bit about what you've seen. What's the commonality amongst organizations who are able to make the leap versus those who have a harder time with making that change?
You say that being Capital One, as one of the institutions that I think is a leader in this space, especially in the U.S., for larger companies. I think, so I'll use that as an example. I think companies that are very tech forward, right, and Capital One came on later on the game with a tech forward approach to being a major credit card company. I think we've seen the medium-sized institutions tend to be at the sweet spot that I've seen in the US. The larger guys are really hard to move, and they're very political in the way they operate, and they have huge stakeholders. The smaller credit unions and the smaller banks don't have the technology, really, or the ability to be that flexible and pilot things the way we've liked to see. So that tends to be the sweet spot. And then even the sort of between medium and large, like the super regionals. I think Regions Bank has done incredible work. Key Bank's done incredible work in PNC on the financial institution side. The one thing I would have disagreed with David, I am more bullish on the employer channel. We've seen a lot of our startups start to make real traction. I think it's in the last few years that's actually really picked up. Financial wellness has become really hot. That's been going on over the last 5 years. So I don't know if this is the same here in Canada, but yeah. About 10 years ago, it was like health and wellness, so everyone was doing yoga in the office place. And then 5 years ago, it became financial wellness, which was really just another word for financial education, which we know is very limited in its impact. And I think over the last few years, now you're starting to see what we call financial health or financial capability become a real part of the benefit suite. So like Walmart offering, partnering with Even, which is one of our lab companies, to help people manage their those financial ups and downs. We're seeing companies doing a lot of student debt repayment because the student debt is a huge issue in the US. We're seeing employers start to offer student debt repayment as a benefit. So thinking beyond just 401k and health insurance as a type of benefits that their employees need. That said, it's not as pervasive as we'd like, and that's only happening at the largest companies because the small and medium-sized businesses don't have the kind of HR systems in place to do that. They're going to be dependent on sort of cloud platforms that are offered by like brokers. So in that case, a company like Mercer is actually a good example that offers a financial wellness platform and app that they can sell to their companies that kind of partner with them. Any other questions?
I just wanted to make a comment. I think I've been really struck when you talked about like the financial services business moving to the financial health business. And I also think about the move from being very transactional oriented, like when you look at the financial advisor or investment advisor community, we've seen that in our regulation of the 28,000 investment advisors across the country where they've gone from transactional to relationship. And so I'm just thinking about, that there's, it's great that all this focus working with financial institutions, but I think it's a lot of those individual financial advisors that build those relationships where you've got consumers that really trust them, and that opportunity to work with individuals looking at their holistic health. And so that opportunity, or that, I think part of that evolution really has to be to focus on those one-on-one relationships, and how do you arm some of those advisors so that they can do a better job being coaches. The other thing too, again, it's Chatham House rules, but a lot of consumers don't realize that they are paying for their investment product, or already, in terms of when they're investing, that they really are paying for advice. So this is an opportunity for the investment advisor community to really step up and to be able to demonstrate the kind of leadership they can play in that advisory role.
No, I fully agree. The one challenge to that, I think particularly for low-income consumers who don't have assets that are going to generate a real AUM, is that the business model is really difficult, right? And so that's where the digital piece comes in, and even phone comes in. So I'll give you a good example. BECU, which is the former Boeing credit union in the United States, just did a partnership, and they put out a report just last week or 2 weeks ago with Ideas 42, which is another great organization in the US, and they were doing a 30-minute, they called it FinHealth Checkup, financial health checkup, and it was a phone call. And they basically emailed their entire customer base and said, hey, free phone call to talk about your financial health and more basic finance than investment advice, right? Credit, savings, debt, et cetera. And they had some really incredible results, and they actually had Ideas 42 did a randomized control trial, so there was a control group and a treatment group, and they could track the people that did this over time. And they found that people had a significant uptake in the number of transactions, in the number of deposits, and the number of savings deposits specifically. So that was really promising, that even just a 30-minute phone call, which is expensive, right? To use your customer call time, but that itself can have a big impact and can be cheaper and more scalable than other sort of one-on-one models.
Hi, here in Canada, a government or a commercial creditor can drain someone's bank account completely, like for payment of a student loan or any government debt, or where there's rate of offset on a credit card, etc. What I'm hearing, I think, from you and the previous speaker is that these products disallow a creditor to take all the money out of a bank account. And if that's the case, do you get pushback from creditors who want to drain accounts?
I don't think that's quite what I was saying. I'm not familiar with that as much.
Okay.
I know that we talked about sort of means testing, and that is a huge issue, and that people who are getting benefits then don't want to put money in their accounts because then it can be taken away or counted against their access to benefits. So again, in the positive light, there's been an actual policy innovation that has been successful in the States recently called the ABLE account. Anyone familiar with this? Particularly people with disabilities in the U.S., this is a big issue, and if they start saving, then they are no longer able to have those benefits, and they actually created a special account where you can put assets in, and you have to use it for certain purposes, and basically anything that helps address your disability, but then it doesn't count against your access to those benefits. And this is just in the last few years has started scaling up in different states in the U.S., so one example of some change there. Any other questions? Okay, thank you.